In September 8, investors withdrew roughly $300 billion from prime money market funds in a single week. And these funds are supposed to be among the safest and most liquid places to hold cash. Yet within days, investors were running for the existing short-term credit market were freezing, and companies were struggling to finance ordinary operation. How can a market that functions normally on Friday become almost impossible to trade by Monday? The answer is liquidity, and liquidity is far more fragile than it appears. In the previous episode, we examined the leverage, how borrowed money magnified gains while prices were rising, and magnifies losses when they begin to fall. But leverage alone doesn't explain why decline can suddenly become a crisis. For that, we need to understand what happens when everyone tries to sell and the buyers disappear. Liquidity is usually defined as the ability to buy or sell an asset quickly without causing a large change in its price. In ordinary language, it means that the price you see on a screen is close to the price you can actually receive. When a market is liquid, a seller doesn't need to offer a large discount to find a buyer. Transaction continues, price move in small steps, and participants assume they can exist whenever they choose. That final assumption is important one. Liquidity is often treated as if it were a permanent feature of an asset. The cash is liquid, property is illiquid, the government bonds are liquid, complex securities are not. But these labels are only partially true. An asset is liquid because someone is willing to stand on the other side of the trade. Banks, dealers, funds, institutions, and individual investors provide liquidity by committing their own capital and accepting the risk of holding an asset. Liquidity is therefore not stored inside an asset. It is created by the behavior of market participants, and the behavior can change very quickly. Under normal conditions, buyers and sellers disagree about value, but they still trust the market enough to transact. When uncertainty rises, that balance begins to change. The sellers want cash because the cash offers certainty. Potential buyers become cautious because they are no longer sure what an asset is worth, whether they can finance it or whether they will be able to sell it later. The price a seller is willing to accept falls. The price a buyer is willing to pay falls even further. The gap between them widens, the transaction decline, and the quoted market price become less reliable. At first, this looked like lower liquidity. Beyond a certain point, it becomes something more serious. The market stops producing credible price at all. This is why liquidity often appears abundant until the moment it is needed most. Every participant may believe an asset can be sold because it has always been sold before. But if many participants depend on the same exist at the same time, yesterday's trading volumes tell us very little about tomorrow's liquidity. There may be thousands of owners who believe they can sell. There is no guarantee that thousands of buyers will be waiting for them. The financial crisis of 2008 made this mechanism visible. Before the crisis, mortgage-backed securities and other structured products traded across a large financial system. Mathematical models produce a price. A credit rating appeared to summarize risk. Banks and funds treated many of these securities as assets that could be financed, traded, or used as collateral. Then mortgage losses began to rise. The immediate problem was not simply that investors discovered a precise amount of loss. The deeper problem was that they could no longer determine where the losses were, how large they might become, or which institutions were exposed to them. Uncertainty about the asset became uncertainty about the buyer. And uncertainty about the buyer became uncertainty about the institution financing them. The market didn't just mark price lower. In important segments, buyer withdrew. The turning point came after Lehman Brothers filed for bankruptcy on September 15, 2008. At the time, the reserve primary fund was an $62 billion money market fund. It held $785 million of Lehman debt. When Lehman failed, the investor required roughly $40 billion in redemption from the fund in just 2 days. The fund share price fell below the stable $1 value investors had expected. A product widely traded as cash had revealed that it could suffer losses. The fear immediately spread beyond one fund. During the week of September 15, investors withdrew approximately $300 billion from prime money market funds. That was about 14% of sector's assets in 1 week. This is the episode central number $300 billion in 7 days. To meet those withdrawal, funds need cash. They sold securities, allowed short-term loans to mature, and became reluctant to provide new financing. In the final 2 weeks of September, money market funds reduced their holding of commercial paper by more than $200 billion, or 29%. The commercial paper may sound remote from everyday life, but its purpose is ordinary. Large company and financial institution use it to payroll, inventory, receivable, and other short-term needs. When money market fund stopped buying that paper, the problem moved from investment portfolios into operating economy. Companies that had not made subprime mortgage could suddenly find it harder to more expensive to fund routine basis. That is how a loss in one corner of finance becomes a liquidity crisis across the system. The distinction matters because a falling price and non-functioning market are not the same things. In a functioning market, prices fall until buyers return, transactions continue, losses are recognized, and capital moves from weaker owners to stronger ones. In a liquidity crisis, the process breaks down. A low transaction price may not represent a considered judgment about long-term value. It may simply be the only price available to a seller who needs cash immediately. The market is still displaying a number, but that number is being produced by urgency rather than ordinary valuation. This is where liquidity connects with leverage. When prices fall, leveraged investor may face margin calls, collateral demand or limits imposed by lenders. They are forced to sell assets to raise cash. But their sales arrive precisely when vulnerable buyers are retreating. More selling pushes price lower, and lower price reduce the volume of collateral. The weaker collateral produces new margin calls. Those margin calls force additional sales. The same assets can therefore fall for two different reasons. It can fail because its expected economic value has declined, or because its owners have lost their ability to wait. During the crisis, both forces create together, and the second can temporarily overpower the first. This also explains why apparently solvent institution can fail during a liquidity panic. Solvency asks whether the long-term value of an institution asset exceeds its liabilities. Liquidity asks whether the institution can obtain enough cash to meet its obligation today. An institution may own assets that will eventually repay in full and still collapse if it cannot sell or finance them before its next payment is due. In calm market, time is available. In a liquidity crisis, time becomes the scarce asset. The large lesson is that markets do not function simply because an asset exists or because prices appear on screens. They function because participants remain willing to use their balance sheet, accept uncertainty, and transact with one another. Confidence doesn't mean everyone believes price will rise. It means participants believe risk can still be assessed, trades can still be completed, and assets can still be financed. When that belief breaks, each decision to seek safety can make the system safe for everyone else. Holding cash is rational for one institution. If every institution holds cash at the same time, credit contracts force the selling accelerates and the market lost the capacity to absorb shocks. What is prudent at the individual level can become disruptive at the system level. What is prudent at the individual level can become destructive at the system level. This is why central banks and government intervene during liquidity crises. They are trying to restore the basic function that private market can no longer perform. Funding institutions, supporting transaction, and creating a buyer when the balance sheet across the system retreating at once. Those interventions create their own risks, incentive, and difficult questions. We'll examine them in the next episode. But before discussing the response, we need to remember what the crisis itself reveals. Liquidity is not the amount of money visible in the markets during calm periods. It is the willingness and capacity to transact when conditions become uncertain, and that capacity is never guaranteed. Liquidity doesn't disappear slowly. It vanishes when everyone reaches for the same exit.